Hello everyone. By now you must have heard and read somewhere about USA's bombing on Iran. With that, America has openly joined the Israel-Iran conflict and it would have profound and large negative implications for India. Given India's heavy reliance on oil imports, it would create severe economic headwinds. In this video, I am going to talk about its impact in 6 points. Number 1, skyrocketing crude oil prices and its ripple effects. Number two, direct impact on Indian share market sectors. Number three, investor sentiment and capital flows. Number four, broader economic and strategic implications. Number five, impact on Nifty 50, gold, silver, oil, and USD to INR. And number six, impact on Indians in general. Let's now see each of these in a bit detail. First is the skyrocketing crude oil prices and its ripple effects. So the first would be the supply disruption fear. Iran is a major oil producer and crucially controls the Strait of Hormuz, a vital choke point through which a significant portion of the world's seaborne oil passes. With this direct US involvement, the risk of disruptions, blockades, or attacks on oil infrastructure and shipping in this region has increased significantly, leading to a massive spike in global crude oil prices. Some analysts suggest that prices could easily jump to over 100 to $130 per barrel and potentially even higher in a severe prolonged conflict. Next, for India is the massive import bill and CAD widening. India imports over 85% of its crude oil needs. A dramatic increase in crude prices would exponentially inflate India's import bill, putting immense pressure on the current account deficit CAD. A widening CAD signifies that India is spending more foreign currency than it is earning, which is a major red flag for investors. Number three is the rupee depreciation. A wider CAD and the increased demand for US dollars to pay for costlier oil imports would lead to a sharp depreciation of Indian rupee against the US dollar. A weaker rupee makes imports even more expensive, creating a self reinforcing cycle of inflation. Next is the inflationary spiral. Higher crude oil prices translate directly into higher fuel prices for petrol, diesel, jet fuel, etc. This rapidly increases transportation costs for all goods, driving up prices across the board: food, consumer goods, industrial products, everything. This leads to higher inflation, both WPI and CPI, eroding purchasing power and consumer demand. Next is the RBI monetary policy tightening. To combat runaway inflation, the RBI would be forced to abandon any plans for further interest rate cuts and would most likely resort to significant rate hikes. Higher interest rates increase borrowing costs for businesses and individuals, slowing down economic growth, dampening investment, and making equities less attractive compared to fixed income instruments. And finally, reduced GDP growth. The combination of high inflation, higher interest rates, reduced consumer spending, and increased input costs for industries would severely hamper India's economic growth. Some estimates suggest every $10 per barrel increase in oil prices can reduce India's GDP growth by 0.3%. Just imagine. Let's move on to the next point, which is the direct impact on India's share market sectors. So there would be the significant negative impact, and the most vulnerable of these sectors would be the oil marketing companies, OMCs. Companies like IOC, BPCL, HPCL, these would face immense pressure as their input costs surge because of the increasing crude oil prices. While they might pass on some burden to consumers, government intervention to control retail fuel prices to manage inflation and public sentiment would severely squeeze their refining and marketing margins, leading to sharp declines in their stock prices. Next would be aviation. For example, Indigo, SpiceJet, and Air India, so Tata Group to a certain extent, would be hit hard as aviation turbine fuel ATF is a major operating expense, around 30 to 40% of total costs for the company in this sector. Higher ATF prices would decimate their profitability, forcing them to increase ticket prices, which in a price sensitive market like India could lead to a significant drop in demand. Next would be the logistic and transportation. Companies relying on diesel for trucking, shipping, etc., would see their operating costs soar, impacting margins. Chemicals, paints, tires, fertilizers industries that have petroleum derivatives as raw materials, for example, naphtha, ethane, propane, etc., would face surging input costs. Companies like Pidilite, SRF, Aarti Industries, Deepak Nitrate, these would see their profitability erode. Fertilizer companies would also be hit due to higher natural gas oil prices for urea production, either increasing prices or requiring higher government subsidies. Next would be the automobile sector. Higher petrol diesel prices could dampen demand for conventional vehicles. While this could boost EV demand in the long run, the immediate impact would be the negative due to increased raw material costs, that is plastic, rubber, etc., and reduced consumer purchasing power. Finally, the FMCG sector. Higher transportation costs and packaging material costs because of the petroleum based plastics would squeeze margins. Now, there would be a limited positive or neutral impact as well. It would be on the upstream oil producers. ONGC and Oil India might see a surge in their revenues and profits due to higher crude oil realization prices, providing some counterbalance. However, their gains might be offset by potential windfall taxes imposed by the government to compensate for rising subsidies or revenue losses. Next would be the gold. Gold prices would likely surge as investors flock to traditional safe haven assets amidst global geopolitical uncertainty and currency depreciation. Gold mining or related companies could benefit. Third would be the defense sector. Companies in the defense sector could see increased orders and positive sentiment, but this would likely to be a very specific limited benefit against broader market negativity. Let's now move on to the third point, which is the investor sentiment and capital flows. In it, first would be the risk aversion and FII outflows. Global investors, that is FIIs, would adopt a risk off approach. Emerging markets like India would be seen as highly vulnerable. This would lead to significant outflows of foreign capital from the Indian equity and debt markets, putting further downward pressure on the rupee and stock prices. Next would be the domestic investors panic. Mark my word, tomorrow morning you are going to see retail investors panic. Probably institutional domestic investors might also react with panic selling, which could accelerate further market decline. And third would be the increased volatility. The market would experience extreme volatility with sharp intraday swings and significantly daily declines. So, tough days ahead. Let's move on to the next point, which is the broader economic and strategic implications. First would be the trade disruptions. The conflict could disrupt global trade routes, impacting India's exports and imports beyond just oil. India's trade relations with Iran and Israel, though a small percentage of total trade, would be directly affected because of this war. Next is the strategic projects at risk. India's strategic investment in the Chabahar port in Iran, crucial for connecting to Central Asia, could face severe setbacks due to military escalation or tighter sanctions. And finally, the cybersecurity and internet. Submarine internet cables passing through the conflict prone areas could be at risk, impacting India's digital economy. Let's move on to the fifth point, which is the impact on Nifty 50, gold, silver, oil, and USD to INR exchange rate. So in it, first is the Nifty 50 fall. As an initial shock, don't be surprised tomorrow morning, that is the Monday morning. You should expect an immediate and sharp correction. In the shorter term, for example, in a few days to a few weeks, a 10 to 20% fall from the current levels is highly plausible, possibly even more. This would push the Nifty 50 significantly lower, potentially towards the 2000 to 2100 1000 20,000 to 21,000 range, or even lower, depending on the intensity and perceived duration of the conflict. If the conflict is protracted and significantly impacts global oil supply for an extended period of time, for example, in months, the Nifty could enter a deeper, more sustained bear market. A 25 to 35% or even more correction from current highs would not be out of question, potentially challenging levels last seen several years ago. Next is the petrol and diesel prices. Now, this is where India faces the most direct and severe impact. Currently, Brent crude is trading around 70 $80 per barrel. If the Strait of Hormuz is blocked by Iran, Brent could realistically surge to 120 to $150 per barrel very, very quickly. And in a worst case scenario, for example, prolonged closure of that Hormuz Strait, potentially even 200 plus dollars per barrel is not out of question. If the Indian government were to maintain current tax levels and pass on the full crude oil prices and oil increase and rupee depreciation to the general public, then if the Brent hits 120 to $130 per barrel, petrol diesel prices in India could easily jump by 20 to 25 rupees per liter, around 20-25% increase from the current rate. So as you might have know that the petrol and diesel rates are very depending upon the state taxes. Let's say that the current prices are around 85-90 for 90 around rupees 90-95 to for petrol. It could easily go to 110 to 125 rupees per liter, and diesel to 100 to 115 rupees per liter. If Brent hits 150 plus dollar per barrel, then the prices would increase by 30 to 50 rupees per liter. That is 30 to 50% increase. And if in extreme scenario Brent crosses the 200 plus dollar marks per barrel, then the petrol and diesel prices in India can easily cross 180 to 200 rupees per liter. So a very very tough times ahead if the common sense does not prevail. Anyways, moving on to the gold and silver prices now. Precious metals are traditionally seen as a safe haven assets and their prices would likely surge. Gold prices could easily rise by 15 to 30% in the short term, possibly more if the conflict prolongs. So a 10 gram 24 carat gold price of rupees say 1 lakh 30,000 or so is not unrealistic. Silver prices too would surge, but due to its industrial demand, it might initially suffer a bit from the economic slowdown. Next is the USD to INR exchange rate. Now the USD to INR is currently trading around 86 between 86 87 due to massive demand for USD for oil imports, FII's capital outflows and general risk aversion driving investors away from emerging market currencies. Uh, the RBI would likely intervene to smooth some volatility, but its ability to stem a major tide of depreciation would be limited. We could expect a rapid depreciation of the rupee here on. It could quickly breach 87 rupee mark, then 88, and possibly even 89 to 90 in a matter of days or a week or so. If the conflict is intensifies and crude oil remains persistently high, coupled with sustained FI outflows and rupee could weaken substantially further, It is not out of the realm of possibility for the USD and INR to reach 92 or even 95 in a more prolonged or severe crisis. Let's move on to the final point, which is the impact on Indians in general. First would be the skyrocketing cost of living, that is inflation everywhere. Fuel prices will rise, resulting in increase in transportation costs, which in turn will increase food prices, manufacturing costs, and utilities cost will rise. Erosion of savings and reduced discretionary spending will be observed. Next would be the impact on employment and income. Business slowdown will take place, resulting in job losses or stagnation. Small and medium enterprises will suffer more due to their less operating margins. Next would be the financial strain and debt burden. Higher EMIs can't be ruled out. Increased credit card debt as people struggle to meet daily expenses. Reliance on credit cards might increase, potentially leading to a debt spiral. People will also face difficulty in achieving their financial goals. And fourth will be the impact on specific segments of the public. For example, commuters. Daily commuters rely on petrol, diesel vehicles, or public transport would face drastically higher travel costs. Students abroad or planning to go abroad, a depreciating rupee means that the education fees, living expenses, and travel costs abroad would become much more expensive in rupee terms, making foreign education a distant dream for many. Next, for tourists and travelers, both domestic and international travel would become significantly more expensive. For farmers, while higher food prices might seem beneficial for farmers, their input costs for fuels and fertilizers would also skyrocket, potentially negating gains, especially for small and marginal farmers. And those with foreign income, for example, IT sector, remittances, etc. Ironically, those receiving incomes in US dollars or other strong currencies, for example, NRI sending money home, IT professionals earning in USD or Euro or some other currency, would see their rupee equivalent income increases, providing some buffer against inflation. However, even they would face higher domestic costs. And fifth would be the psychological and social impact. Increased stress and anxiety, the constant pressure of rising costs and financial insecurity would lead to increased stress and anxiety among households, reduced quality of life for many, particularly the lower and middle class. The quality of life would deteriorate as they cut back on non essentials and struggle to maintain their standard of living. And the potential social unrest, while difficult to predict, prolonged and severe economic hardship, especially driven by essential commodity prices, can sometimes lead to social discontent as well. So now, as the USA has joined the Israel Iran war, the Indian share market would likely face a severe, prolonged bearish phase. The primary driver would be an unprecedented surge in crude oil prices, leading to cascading negative effective across the Indian economy. High inflation, rupee depreciation, increased interest rate hikes, and dampened economic growth. While a few sectors like upstream oil exploration might see temporary benefits, the overwhelming impact would be negative, leading to widespread investor panic and significant FIIs outflows. The government would face immense pressure to manage both the economic fallout and potential social unrest due to soaring fuel prices. America's entry in the war might trigger an unprecedented level of uncertainty and risk with severe consequences across the global markets, and particularly for import dependent nations like India. In essence, the entry of America in the Israel Iran war could translate it into a cost of living crisis for the average Indian, making daily life significantly more expensive and financially challenging, and potentially leading to a broader economic slowdown with job insecurity. Finally, let's just hope that the common sense prevails in the days to come and the world leaders come together and resolve this war. Thanks for watching the video and share your opinion in the comments box. Thanks.